a few things that you need to consider when it comes to taxes as a trader. The first thing is, as an investor, you can't deduct any sort of expenses unless it's directly related to the actual trade. So commissions get factored into your cost basis. Those are deductible. But interest is not deductible as an expense. It's deductible only like as a miscellaneous expense. And then it gets a little complicated. Also, if you do some margin interest, you may not be able to deduct it because you're an investor. So there's a little kind of some nuances if you're an investor. And then the big one is something called wash sales. Let's say you trade Apple every day. You buy it, you sell it, you buy it, you sell it, you buy it, you sell it. You do it a bunch of times. Even if you do it every week, it's going to create what's called a wash sale. And because the IRS doesn't want you to sell a stock at a loss and call it a loss on your tax return, if you're an investor, and then buy it back the next day, they have this deal where they say, okay, any losses from a wash sale have to be carried over, which basically means you can't deduct them. So if you trade the same bunch of stocks every day, essentially, you're never really going to be able to deduct any losses. And that's really not a good thing if you're an active trader, because if you can't deduct the losses against your gains, you might be amassing huge amounts of gains. So it's definitely something that you have to consider. Another thing you should consider is that there's a $3,000 annual carry forward limit to the amount of capital losses that you can deduct against your income. So let's say you have a net loss of capital gains or capital loss, whether it's $50,000 or $100,000 or whatever, you can only deduct $3,000 per year against other income. You can deduct against other kind of capital gains for sure. But if you have real gains against other income, you can only deduct $3,000. So if you lose $100,000 in the stock market, you deduct $3,000 for about 30 or 35 years before you get that back. That's just not a very good deal. You want to avoid being classified as an investor if you're going to be doing active trading because of the wash sale rule and the tax implications it's going to have. The expenses that you have, not just interest, but other expenses, you're not going to be able to deduct it as a business expense. Like if you subscribe to the Cash Flow Private Access Group or any other trading courses that we have, that expense is not deductible for you, except that it might be deductible as a miscellaneous expense. And those kind of issues can get complicated. Now, what you can do is you can become a business trader. Here's what's good about it. First of all, it's a business. It's like you're running a store. You buy and sell inventory. That's your stock. Now, I'm a full-time trader and investor, and that's been my career job for a long time. Basically, what that is saying is that I can deduct all my normal, ordinary expenses, parts of the places that I live, if I have an office, if I use CNBC and TV, anything that I use is deductible to the extent that it's a business expense. Anytime you are in business, you get to deduct those expenses from your income. So whether it's you get a brand new computer or whatever, you get training and coaching, all those things are part of running your business. You can deduct some things. The problem, though, in becoming a business trader, it's a little bit more difficult. There's some hoops you got to jump through. And there's a little bit of uncertainty around it. The IRS may try to change your election as a business trader. Like, you don't want that to even be close. You have to be really solid on what the IRS can and can't do. You've got to be pretty convinced that you're a business trader. Okay, so if you're like me and you're full-time, you spend almost all your day doing this, you're probably fine. If you want to become a business trader, according to IRS publication 550, you want to look that up. First, you want to seek to profit from daily movement. Whether it's daily or whether it's every couple days or whether it's weekly, I'm not sure. But you just can't be an investor in that case where you just buy it at the beginning of the year and sell it at the end. So if you buy stuff and hold it for a couple months and you don't trade, that's really not going to work for you. You've got to have some significant activity in your account to show, hey, look, this is my business. This is what I do every day. You also have to trade with some continuity, and you got to trade with regularity. So you can't just do it for 2 months and then go on vacation for 10 months and say, well, I'm a day trader and that's my job. You got to pretty much do it to show the IRS this is your business and it's not a hobby and you're just not an investor. You're trying to spend a lot of your time investing. Now, I spend every day looking at the market. I spend every day studying the market, even weekends. I spend about 3 hours on Sunday preparing for my week. And there's times where I may not make any trades or maybe just one or two. And the argument certainly could be made that I'm doing it full time, just that I'm not trading like crazy. It doesn't mean it's not my business. Does it make me an investor, IRS, if I'm still doing this full time? I mean, if I open a store and nobody comes into the store to buy anything for the week, am I not a store? Am I not a legitimate business? So you got to use a little common sense here too. First, your typical holding period is going to be fairly short. Also, you should be trading large dollars of stock. If you're buying and selling 100 shares of a $1 stock, it's not going to really move the needle. So I trade millions of dollars a year. And if you do it in any active way, it adds up pretty quickly. Also, you should derive a substantial portion of your income from doing trading. you have an opportunity to make a lot of money. You're also going to have a lot of opportunity to lose a lot of money too. We don't want to do that. So if you have a $10,000 account, the IRS is going to say there's no way you could reasonably expect to make a living from a $10,000 account. So you don't qualify. All right. So they're going to be pretty sticklers on that. But if you got 100,000, 200,000, something you could reasonably make good money on working full time, in general, the smaller your account size, the less likely the IRS is going to say that it qualifies as a business trader. So then bottom line is also, you also need to devote a lot of your time to trading. If you do it part-time, but you spend 4 hours a day doing it, then that might qualify. I mean, it just depends on what you think is a business. The important thing is somewhere in the middle. So if you do it full-time, you trade every day, do millions of dollars a year, your full-time job, the IRS probably is not going to give you any flack, any problems at all, especially if you make money. If you lose money over and over, year after year, if you trade part-time, the IRS may have some issues with that. Call it a hobby, and it's going to be a lot harder to get business tax treatment. Now that we've talked about getting business tax treatment, let's talk about another special kind of thing, marking to market.